And welcome, everybody. I'll echo the warm welcome that we got. Thanks for being here. I think you guys are going to like what we've got queued up for you today. Anyone who was at Summit, you will notice some overlap, not 100%, but you will notice some overlap because we just did that, just a week ago. So, obviously some of that is still quite fresh. All right. Let's get going. Kind of a nice little feature there. See what we did there? Pretty nifty. All right, as we sometimes joke, today we get to talk about the love of our life, residential real estate. Just a real quick agenda. I won't read through the whole thing, but mostly talking about the market. We will touch on some different segments. We'll talk affordability. You know what? I may either breeze through some of the demographic and economic stuff at the end, or maybe we can skip it and do some interactive charting on InfoSparks or in our Fast Stats tool. So let's see how we do with time. Oh my goodness, it's 2:10 already. I better get cracking. Okay, so all of our many reports, we have many wonderful reports. Most of them live here in Fast Stats. A couple others that live here under market data. So again, just really encouraging you guys to use this, become familiar with it, use it, learn it, and understand how to leverage it with your clients and in your business planning. It's not just for them, obviously for you as well. So a lot of different reports, a couple different ways to access them. And so just so you guys are aware, a lot of different metrics, a lot of different ways to access and see those. We've got definitions, explanations, and the monthly indicators in InfoSparks FAQ section. And so hopefully that's helpful. If not, reach out to us. I mentioned we have a whole bunch of reports. Here they are. I think we kind of eliminated the quick take, so that's probably the only one that has been sunset, if you will. All right, well, let's dig in. What's happening from a longer term perspective? I always like to start sort of high level and then sort of dig in from there. So a couple things to think about as we are thinking about market cycles. There's typically four sort of components within the cycle. There's expansionary, there's oversupply, then we get into recession, and then we get into recovery before we rinse and repeat and kind of do the whole thing over again. So what's interesting is we're definitely not in oversupply territory, although new construction is becoming fairly balanced with around 5 months of supply. It's just kind of the business cycle. It's just kind of how it goes. We realize we're a little overdone, and then we kind of go into recession. And then when that's over, we start to recover. And then we're really in this expansionary territory before we realize maybe we got a little bit excited and need to pull back again. So just so you guys are aware, that's sort of, those are sort of the components of the cycle, if you will. A little bit of a long-term view. I know a couple of you have seen this before. We are looking at new listings in blue and closed sales in red. And sometimes we will show you guys, look when we had this divergence. Let me get my laser going here. Look when we had this sort of divergence between supply and demand, that got us into trouble. But what we've been saying lately is that supply and demand have been downshifting together. Instead of sort of diverging, they're sort of moving together in tandem, if you will. All right, one more long-term chart. I've got this sort of cycles in here. I wouldn't think too much about that, or I should say the different decades sort of. You can see the bubble, you can see the crash, and you can even see the frenzy during COVID, sort of that COVID frenzy. And now, just into last year, we started to see things level off a bit. Prices are not declining, but they are increasing at a slower rate. The rate of price growth has decelerated. And then just sort of noting a couple of those. Okay, showings. So I've been using these. Why? I've sort of answered that in the lower right, right? This is the thing before the thing before the thing. Everybody wants to see around corners, and that's difficult to do. But if you want to look at closings tomorrow, look at pendings today and look at showings yesterday. So it's just another way to get a little bit ahead of the curve when it comes to forecasting demand. So what's been the consumer response to these higher rates? Well, they're waiting for rates, or they were waiting for rates to ease before scheduling showings, or at least they needed some time to adjust to these higher rates. So here's one way to look at it. You can look at showings for the most recent week this year compared to same week last year. I'm seeing gains all across the board, but I'm seeing a pattern. I'm seeing stronger gains as you get up the price ladder. Right? In fact, the strongest gain was in million plus. Second strongest was 600 to 800,000. Then we get 400 to 400 to 500. Then looks like we go down or go up to 800, up to a million. So you guys can kind of see where the strongest growth is, and it's where the buyers are the least rate sensitive, right? It's where the buyers are the least rate sensitive. Buyers are pretty rate sensitive down here. Most of those folks have to borrow, have to take out a mortgage. Not all of these folks do. And I know that's somewhat counterintuitive that these homes cost, significantly more, and yet people are able to buy them in cash. You see some investors, you do see some cash activity down here, but there just isn't the inventory. So I think that's why we're not seeing as many showings. Also, buyers in those segments are more rate sensitive. So now March of this year versus March of last year, and now we're actually looking at new listings. Well, sure enough, I definitely see the supply coming on the higher end of the market. Looks like I see declines in new listings, I guess a flat one, mostly declines in new listings under 350. So our median is what? It's just about 365, 370. So that's, I guess it's technically in this range, but it's sort of this cutoff, right? Call it 360. It's sort of that cutoff. So if you wonder where the supply is coming in or what sort of product is getting listed in the metro, this is the number one gainer. You got some 450s and 475s in there. Sometimes those are the Lakevilles and Blaines, people selling their South Minneapolis or Richfield or, St. Louis Park, the first home, selling that for 350. They bought it for 225. They're selling it for 350. They got nice equity, and then they're trading up into a 450 or 475, with the fourth or fifth bedroom, and closer to 3,000 square feet than 2,000, just for an example. Pendings. Okay, so we want to see if listings and pendings are following one another. Are they in sync, or are they sort of, again, diverging or doing different things? And what do you guys see here? I see pretty clear evidence that we're seeing the same thing. We're seeing the growth in demand in the upper price brackets. I suppose you got a move up bracket. People call this the move up bracket. But as you get into luxury, you really start to see some strong growth in pending sales, almost a 25% increase. So for every 4 signed contracts over $1 million last year, you've got 5 this year. So again, this idea of rates and affordability is going to be a theme throughout. So here's yet another consumer response to higher rates. So how are we adapting, you guys? What's been the response to the environment, to the rapidly changing environment over the last 2 years? I don't know if you guys saw, we had some unfortunate news with some of the CPI data. Was that Monday? I thought that was last week. Maybe it was Monday. Anyway, so it looks like the 30-year rate is back up to 7.3 or something after touching 6.6. And I know people were really looking forward to low 6s. Some are even saying maybe high 5s by fourth quarter. I don't know how likely that is anymore. It's a little tricky to, it's very tricky to forecast that, but seems like the Fed is committed to staying put, and it seems like they're committed to staying a little bit higher for a little bit longer to make sure the inflation stuff is kind of put to bed. So showing activity, down mostly for the first-time buyer segments and more rate-sensitive buyers, but up uh, as you get into your higher-end brackets. Like we've talked about, sometimes they've got huge equity from the first and second homes, and oftentimes they have cash, well over $1 million in cash. Buyers and sellers, what's going on? So February new listings, I've got March as well, but I wanted to show February. Saw really a nice gain, guys, 36% gain. That actually put us above February of 2022 levels and pretty much matched up with 21 levels. And actually, we're even above Feb of 2019 levels. So pretty encouraging sign when it comes to new listings. And so I'll ask the question, are we ready to take the leap? Are sellers finally ready to kind of jump into the pot, or kind of get out onto the dance floor, so to speak? March new listings, not as much of a gain, and so it's not as encouraging of a chart. What is encouraging is that we're not losing, right? We're not losing listings, but this was a pretty small gain, although February, again, was a 35% up month, which is really strong, really strong. I know most of you have seen this one. I've used this one for months. Every session, we have a few new people. Summit was new people, so I like to kind of take it out every now and then. Guys, 70% of mortgages are financed below 4%. This is all just a way of saying people feel married to their interest rates or handcuffed to their mortgage, where they're not willing to let it go because they know they have the triple punch, the triple threat, right? Low inventory, higher prices, and rising rates. The good news is we're starting to see a little bit of movement on the inventory side. As you guys saw, we've had some pretty decent months for new listings. We've had a decent couple months for pendings, but not quite as robust. So both are up, but when listings are up more than sales, that inventory, sort of that residual inventory, is left over at the end of the month. And so we count it as, of course, it's counted as part of inventory. So there you go. Sellers were kind of hunkering down and waiting things out, but the pent-up pressure to list is now finally being unleashed. And yet some remain married to their mortgage rate, interest rate, both. Sometimes I've joked, we've got a pretty high divorce rate in this country. And so if you think you're married to your interest rate, just give it a few years. I think you'll grow apart. Anyway. And then don't forget, most sellers are also buyers. So rates are still, well, at the time of writing this a couple days ago, they were 7, now they're about 7.3. And so maybe we are more used to it, and at least it's down from 8, although not as much as we'd kind of like it to be. So this is from NAR. This is sourced from NAR. Pent-up sellers cannot wait any longer. What happens over 2 years? So rates really started to kick up in kind of second quarter of 22. So we had, 22 and 23, and now we're right now at kind of second quarter of 24. So we really had 2 years, and we had 2 years of pullback, I should say. And so what do we see happening here within 2 years? 7 million babies born, 3 million people getting married, 1.5 million divorces. What did I just say? About a 50% divorce rate, right? Anyway, 7 million, boomers are turning 65. Deaths, new jobs, job switches. Guys, life happens. There's changes all over the place, all the time. And sometimes that necessitates a move, whether rates are 3 or 7%. Sometimes you gotta move. And so, just one way to think about all the pressure that's building up, sort of, steam pressure building up, and is just now starting to be unleashed, kind of blowing off that steam. And then March pending. So again, a little bit of encouraging news here. I shouldn't say a little bit. An 8% bump is a nice little bump. It doesn't magically put us back here, but it also means that we're no longer kind of down in some of these spaces. So nice to be above 4,000 again, although not by much. So keep watching this one. We'll keep watching that. Yeah, Feb closings, real nice month for Feb. I think March was flat. I think March was 0 or 0.1%. And sometimes that's weather stuff or just who can hit the closing table, or whether it's a 30, 45, or 60-day close. And so sometimes that's a little, wonky. And that's why, we like looking at pendings, as much, if not more so. The COVID frenzy, pretty evident here, right? Feb of 2021, easily an all-time high for closings for any February over the last 22 years, right? So I don't know, so let's see, we have to get to 2028, and then I'll be able to say that was a quarter century high. Wow, we'll be able to say that's a quarter century high. That'll be an interesting thing to be able to say. Tying this back to how consumers are responding or, kind of adapting to the new rate environment, buyer activity is ramping up as rates have eased, at least until this week. So let's see if that causes an impact in the weekly and the monthly numbers. But as I said, we're still a ways below the peak. Pendings are a good leading indicator, but closings do sometimes fluctuate a bit. And then you also note, though townhomes and condos tend to be more affordable, most do still want single family, like it or not. A few reasons why people move. I like this one. This one kind of made me chuckle. I hadn't heard of this until just last month. I'm almost ashamed to admit, I just hadn't heard of this until last month. A few reasons why people move. The 5 Ds: diapers, diamonds, degrees, divorce, and death. Hopefully, oops, wait a minute. Hopefully the diamonds come before the diapers, although not here to judge what people do. But those are the 5 Ds: diapers, diamonds, degrees or diplomas, divorce, and death. Best time to buy is when you're ready, and the best time to sell is when you need to. So this kind of makes me think of the 4 stages of life. Baby bottle, soda bottle, beer bottle, and then IV drip. That checks out. All right, let's shift gears into market times and negotiations. Days on market. So I'm mostly getting out of using annual charts, you guys, because I know here we are in the second quarter. I typically don't use them much past March, but there is still, some interest, in the beginning and middle of March. As we get into April, May, people want to look at data for spring market for Feb, March, and April. So I'll just say, this is annual. So last year, homes spent 18 days on market, half above, half below that roughly 2.5 week mark. But we hadn't seen a decline. Obviously, 2023 still up. But look what we're seeing in March. 27 minus 3 down to 24. That's a greater than 10% decline. Doesn't get us to home selling in 11 or 12 days, right? Week and a half. Doesn't get us back there. But it does get us back to a pre-COVID level, I guess below a pre-COVID level, and below a 2020 was about half of it was a kind of a COVID year. But no, we are not back to those levels, but it is nice to see, home selling faster. Median days on market, single family, 21 days. Condos, almost 2 months, 55 days. Caveat here, guys. These are median, right? These are median. So 55 and then 26 for townhomes. So single family is still selling the quickest. Sometimes we use this as a joke. Don't call me overpaid just because I sold your home fast. That's exactly what you wanted me to do. Percent of original list price received at sale. So sellers are getting just under 99% of their original list price. That is down from 102 and gosh, almost 103 during the COVID buying frenzy. But you also notice, not only is it up from the prior March, here again, guys, it's also, pretty well matched up with 18, 19, and 20 levels, right? Sort of right in the middle there. Does this vary by property type or construction type, just for example? Looks like it does. We do have some important and somewhat significant variation. So single family sellers, those guys are getting 100%. They're getting all of their original list price. Condo sellers having to take about 2.5% off of asking price in order to get a deal done, right? So they're accepting more like 97 1/3% of list price compared to 100 for single family and 99% for townhomes. So townhome sellers still doing pretty well. 97.5 or a third historically is still pretty good, but it is lower compared to its other property types or its property type colleagues, acquaintances, whatever. Prices and inventory. March prices. So you guys can see after we really flattened out, guys, we were up a grand, 355 to 356. That was 0.3%. It's about as flat as you get, right? Minus being absolutely perfectly flat. It's about as flat as you get. So you can see we really flattened out. Now we're back to pretty modest gains, right? Pretty modest gains. It is nice to see, gains returning. Although, let's be careful about getting back to 10, 8, 17%, because that's just not sustainable. And given where incomes are and where affordability is, I'm not sure I would wish for that. Although it is nice for sellers to see, equity growth returning. And I think that is motivating to them. And, one more sort of encouraging push factor to help them, to make them feel better about listing their home. Prices are still rising. It's not like prices are down 10% where I'm going to get a week offer on my home. So hopefully this means they're a little bit more willing to list. And sure enough, we are seeing that in the data. Yeah, I know what all the comps say, but my house is special, right? It's always special. Inventory in purple. Is that fuchsia? I don't think that's not fuchsia. Maybe it is fuchsia. Anyway, inventory levels. We used to have 33,000 properties listed under active status in the North Star system. You could write offers on nearly 33,000 different homes. 15 years ago? A little longer, 16. Last month, we did see an 8.5% jump in inventory, but only to 68 or 6,900. Well, that's nowhere near 20,000 or 30,000. That is well below. I like to point out, guys, we've had head fakes before. This was a head fake. This was a head fake. I kind of think this one feels more real just because of what we've seen with rates and because of what we are seeing with seller activity, with new listings. So as long as rates don't magically drop to 5%, which they won't anytime soon, given where the Fed is at, I think we can keep growing here. If demand is, still there, but not really surging, but new listings are coming on, well, that will add to inventory, right? That adds to inventory. So when there's relatively more product coming on, but relatively less, I should say, fewer listings flowing off the market, that is inventory positive, right? That's going to be that's going to push inventory higher. Month supply, 1.8 months of supply. It's not a lot. It's not enough. Not a lot, not enough. 1.8. It is 80% higher than the 1 month of supply that we saw in March of 21 and pretty much the same in March of 22. So here we are, not even 2 months of supply. In other words, still below pre-COVID levels, below kind of that half a COVID year. But yes, we are not there anymore. We do not have 1 month. It would be nice for us to get 2 months of supply. We are aiming for 4 or 5, right? So you guys can kind of see 4 right about here. So there would kind of be your 5. We're not shooting for 7, 8, or 10, but we're also not shooting for 1.5 or 2. So we are still well undersupplied. Okay, diving into some segmentation and market share. Let me do a quick time check here. We are at 232. Okay, I think we're doing okay. Yeah, as I'm thinking about it, some of these are pretty interesting. I know some of you have seen these once or twice. So we'll go through these pretty quickly. So here's another way that consumers are adapting. share of homes that had 4 or more beds. What do you notice about 2020 when everybody needed to work and learn remotely? We needed that 4th or 5th bedroom. Now that rates are over 7% and prices are ever higher, it looks like more people are willing to entertain a 3-bed, right? Or 2-bed condo, right? Or well, 3-bed townhomes, I think, start to get a little pricey. If you're looking for a 3rd or 4th bed townhome, you're probably gonna lean towards single family. But just so you guys can kind of see that, 42% had 4 or more beds. Now, a little under 40, more like 39, 39 and a half. Okay. Oh, and then, we've seen this one before, townhouse condo market share. 27% of all sales are either townhomes or condos. And the remaining, 73% are single family. 27.1 is just behind 27.9. It's the second highest in 21 years, second highest level. So because the price points are a little more attainable, I think that's why folks are willing to consider it. So some buyers are considering slightly smaller homes, fewer square feet, and some with 3 beds instead of 4. And sometimes they're considering townhomes or condos, but clearly not all buyers, and actually not even the majority of buyers. But why? Let's look at why. Single family, 400,000, condos, 205, and then townhomes, 305. Well, no wonder you're seeing a greater share of sales, from these two segments, because the price points are better, right? The price points are better. And therefore the payments are better. So if, someone needs to get their monthly payments under 2,000, 2,500 a month, these two property types may offer more promise, right? You may be more likely to succeed in those segments. Now, does that work for every, say, millennial family? No, not if they're stuck in a rental and they need more space, right? A condo probably isn't going to work. But you think about a downsizing boomer who can sell a 400K single family home, and well, there's not a lot of $200,000 condos. Believe it or not, that is the median. But remember, as you get out there, you can find some 180, some 160 and 180 and 195 condos. But most people think of condos as downtown, and you're not going to find many downtown condos for 200 grand. You're just not going to. So, makes sense. And so you think about millennials who are looking to maybe little more space for kids, and then baby boomers with kids well out of the house. And now the boomers, their backs and knees are getting older along with them, and they're thinking about maybe not doing the lawn and the snow care, lawn care and snow removal, I guess I should say, on single family. And so they're looking at an HOA to do that kind of thing. Although I gotta say, we've been hearing HOA dues have been on the rise, and yes, taxes are partly causing that, but we've been hearing it's mostly insurance. It's mostly insurance, which is a challenge. What levers do we have, right? What levers do we really have to deal with that? So that one's tough. Construction type, new construction, 480,000 for new, 355,000 for existing. Guys, existing home prices, since they're lower, okay, so some people, the demand is going to be there for some. So those prices got pushed a little bit higher. But look at our friends in the building community, right? Look at our builder friends. They are being creative and innovative, and they are figuring out ways to either, do the 3rd instead of the 4th, or a 4th instead of a 5th bed. They're finding ways to maybe not finish the basement, to maybe not do the bonus room, and instead just do, the 4 beds, not the 4 plus bonus, whatever it is. And they're also doing rate buy down. So, the builders really are getting creative in getting units sold. And they're such a needed, they're really a necessary part of the market. And really, builders are the ones providing the supply now, because everyone's kind of hunkered down, not everyone, a large share of people are kind of hunkered down, holding on to their interest rates. Well, builders aren't married to their interest rates. Builders want to move their product, right? That's That's their business, selling new homes. And so they want to offer these incentives, and they don't want to hang on to the product, right? They don't want to hang on to it and eat the holding costs. So I thought this was pretty interesting that new home prices have come down just about 4.25% after they sort of hit the 500,000 mark. But guys, like always, know that you can find some new builds for, if you're really lucky and you look hard and you're maybe further out, maybe 3.25, but you can also find some in the 6s and 7s. So here we are sort of in the middle. Makes sense. New construction market share. So I've updated this with 2024 year-to-date data. Every other year is complete annual data. It's a little tricky. And I think that's why this looks like such an extreme move, is because year-to-date is only the first quarter. So we got Jan, Feb, and March. Well, those are, I almost caught myself saying those are colder winter months, but we didn't really have a winter this year. So builders, were able to do pretty well. And part of that is because of what we talked about, but the other part of it is that it's not necessarily that new builds have surged as much as existing sales have slumped. And so that leaves new construction sort of standing out head and neck above the rest. Let's check again once we're at July. We'll do a first half. And then, I guess in January of next year, we'll do a full year analysis of 24. I suspect it will not be 16. I guess I'd suspect 13.5. I don't know that we'll break this. I'd suspect 13.5, maybe 14. Let's see what happens with rates. Ooh, interesting. Guys, let's go back. We got to go back. Hang on. Percentage of all sales that were new construction. What's this? Percentage of all inventory. Percentage of all active listings that were new builds in the metro. Huh. This is interesting. So although new builds only make up, let's go with last year's number, guys, 12 or 13% of all sales, gee willikers, they're making up 3 times that share, 12% to 36% of inventory, right? So, yes, market time, yes, that's a market times thing, but it's also that existing inventory, it's just not there as much. And so we see new construction making up a larger share of that pie. I like to tease out Lakeville, 34% new construction, right? They've got some land, not a lot, but they've got some land. Pretty decent schools too. Similar story with Blaine, 30, 33%. So 1 in 3, 1 in 3 sales in Blaine are some form of new construction, right? Maybe some of you are thinking this may have to do with, the city. Yes, but also as you get further out, there's just more developable land. And so where you can buy the dirt is where you build the homes. There's obviously other factors, but I think it does matter what's the word? Not the culture or the disposition, not the attitude. I'm not going to come up with the right word. The approach or the attitude toward development. And maybe the Blaines and Lakevilles and the Woodburys are a little bit more open to that than, I shouldn't say Maple Grove. Maple Grove's doing great. Corcoran and Medina, they're doing fine too. Rosemount and Farmington also strong. But just know that this does vary city by city. Blaine does seem to be an area that is, uniquely committed and open to new construction, and just doesn't have the hurdles. So I guess that speaks to the regulatory environment and some of the permitting processes. In Blaine and Lakeville, builders are builders are voting with their feet and voting with their dollars and their heavy Caterpillar equipment. They're saying these are areas where we're able to build in and that are open to us coming in and developing these communities and providing home ownership opportunities for people. I've noted what I've said, mostly having to do with the existing segment sort of pulling back. Basically what I said. Private housing units authorized by building permit, 1-unit structures here in the metro. What do we notice? Pretty high level here at the peak just before the crash. Looks like 04 for permits, meaning those units were delivered in 05 or 06, which was pretty much the peak. Remember, well, yeah. So look at this, guys. Here's the Great Recession. Here's the gray bar. The gray bars are recessions. Here's the dot-com bubble bursting. Here's the housing crisis and great financial crisis. Here's the brief COVID recession. Look at the permits, right? Way down and then way up. And then interesting here with higher rates, we did see that pullback, a little bit coming back, but not quite kind of back on this trend. I think we will be maybe later this year or next. Let's see what happens with rates and recession. I think both are important. I got a little granular. Let me zoom out. I was a little micro. Let me get more macro. Guys, what else do you notice? What I notice is population levels are higher than when they were here. So population's up here, but building permits are down here. We've been underbuilding in this region, and frankly, most regions across the nation. We've been underbuilding in our area for 20 years, right? 20 years of underbuilt, maybe not quite 20, 17, right? A decade and a half, almost 20 years of underbuilding. No wonder we have an inventory shortage, right? Oh, where did this inventory shortage fall from? It must have fallen out of the sky. No, it's a result of this, right? It's a result of this. So sometimes I like to say, I actually really kind of like this. Housing supply is structural, but housing demand is cyclical. And so let me just spend 30 seconds talking about that. Housing supply takes just that, permits, right? It takes moving equipment onto a site. It takes grading, roads, utilities, stormwater retention. It takes labor. It takes capital. It really takes a lot. Just go on to a job site and just look at all the things they have and people and lumber and all of it, all the trades. So housing supply really is structural in that sense. Housing demand is more cyclical. Rate cycle up, demand slows. The rate cycle, rates go lower, demand kind of speeds up. So, and then also just with the business cycle, like what we saw with expansion, oversupply, recession, and then recovery. So I kind of like this way of thinking. Housing supply is structural, but demand is more cyclical. So sort of a interesting thought. These days, everyone has more interest in rates. I'm not paying 7% interest on a mortgage. Yeah, well, rent is 100%, right? Rent is 100%. Let's do a reality check. Let's just pause and do a quick reality check. 75, 80, 85, 90, 95, 2000, 05, 2010, 9s, 14s, 13s, 10s, 9s, 8s, 5, 5. Yes, some 4s and 3s, and now about 7. So sort of taking this in context, in that historical context, may give you a different insight. This may help buyers practice acceptance, right? Work on practicing acceptance. May not be able to change the world as it is now, but you can start to accept things as they are. All right, here's a rate sheet from 1982. Yeah, you read that right. Fixed 30-year rate starting at 18% with a point. Buy down to 16.75 with 5.5 points. Wow. Feel free to page Jim at that number. He might answer, never know. Here's our HAI, our Housing Affordability Index. Higher numbers, greater affordability. So prices went on sale, affordability really surged during the bubble. Affordability obviously not as good. We were kind of hanging in there, incomes were growing, same with prices. So things kind of looked okay. And then the feeding frenzy started, and then the rate hikes really started in 2022. And you guys can see it really was the rate hikes. In 21, it was just really strong price growth, right? We saw that. So it was really strong price growth. And that's what kind of brought affordability down. But then, over the last 2 years, it's been much more driven by rates. And sometimes we like to show this one. 2021 versus 2023, sort of the market explained there. Well, I got the house for cheaper, so our payment went down. I got 10 grand off our list price. But 3% versus 7%, look at the payment, 2,000 versus 3,100. So obviously a big difference there. Shifting gears a little bit, let's talk about our guy Jerome Powell and the Fed and really FOMC, the Federal Open Market Committee. You guys can see there's your long-term interest rates. I want to put a little kind of channel on those, if you will. And so we were kind of bound here, right? Bound up here for a while, bound in this range. All of a sudden, we broke out of that range, right? No problem. We were stuck in this range since 1985. That was our range. We were on a downtrend. The channel is a linear downtrend, but the data itself is pretty volatile, right? It's a pretty noisy data set. And that's why sometimes it's useful to put, sort of linear bounds, on data like this. And so, pretty clear to see. Sometimes we're at the top of the channel, sometimes at the bottom. Top, bottom, top, kind of middle, and now above. So clearly something happened. And what happened is we had the highest inflation since this point, since the early 80s. So that's why we kind of broke out of that long-term trend, if you will. And then we saw 8%, and that was the highest level since 01. I think it was September of 01. We've settled down a little bit from those levels, but sadly, just not that much, especially with the latest figure. I like this one. It's a good way for me to kind of think about rates, the trilogy, right? Rates, prices, and payments. Rates, prices, and payments. So sometimes I say the way I read this is just on a diagonal. I read it this way. So I find 2,500 and I follow it up, right? Roughly 2,500 is all, kind of here. So if I'm borrowing, if rates are 5.75, I can borrow 440 grand for a 2,500 a month payment. But as rates are 7.25%, if I want that same 2,500 a month payment, now I can only borrow 360K. So kind of pick your rate and your price or your loan, and kind of there you go. And when rates were down here and you wanted to borrow that much, this is kind of what your payment would be. So I know you guys know this. I'm not going to spend much more time on it. Ooh, speaking of time, we're starting to run shy. So payments, most of you have seen this, a little bit discouraging, but as I say, I'm not here to make you guys feel good. I'm here to share the truth, and I'm here to talk about the data in terms of what's really happening. So about 2,700 a month is the typical payment on the median priced home. Just about 2,700. You guys will notice that is about 1,000 higher than it was 2 years ago. That's $12,000 a year. Typical family is earning about 120,000 a year. 12,000 out of 120,000 is 10%. That's a 10% increase in the whole, not just, well, I suppose it is housing costs, but it's a 10% on the whole earnings, right? The whole budget, excuse me, not even budget, the whole pre-tax earnings, 12% of that household's income, 12%, excuse me, 10% more, 12,000 out of 120,000, 12% more of that household's income. Did I just say it again, guys? 12%, 10% more, 12 extra thousand, 10% more of that household's income has to be spent or committed to their home. That means they're not saving as much, for retirement, 529 stuff for kiddos, and they're not spending it as much in the economy. And this economy is about 60, I think it's actually more like 70% dependent on consumer discretionary spending. Well, if I'm spending 10% more of my income or 12 grand more a year, just for shelter to live, um, I'm not going to be as excited about buying, the new car, the new iPhone, the new, jacket, whatever, going out to eat, right? Restaurant, whatever it is, jewelry, whatever, spa, nails, all of it. So discretionary spending can sometimes, kind of pay the price for this. Really like this. It's just for me, it's a clean way to kind of think about it. Lack of affordability and higher rates are preventing prices from rising much, sort of acting as a ceiling. But then again, a shortage of supply is preventing prices from falling much, sort of acting as a floor. Let's see. Should we jump? Let's do one real quick cash sales. Guys, cash sales at over 17%. That's the highest level since 2013, right? That's a 10, 11-year high. And no wonder. Rates are as high as they've been since 2000. Right? Yeah, rates are as high as they've been since 2000. Excuse me, 01. And so, no surprise you'd see people start to take out checkbooks and start to, use cash instead of a loan if you're able. And obviously, not everybody's able. So, one of the toughest parts about all this is, how this impacts first-time buyers. Move-up buyers are faring a little bit better because they've got 100K or 200K in equity from the first home, right? They bought it for 180, it's probably worth 380. Or they bought it for 250, it's probably worth 350, as long as you bought it more than, 5 or 7 or 8 years ago, whatever it is. They've got that equity to bring to put as a down payment, which lowers their rate. Excuse me, which lowers their payment. Same rate, but you're borrowing less, so the payment is less. Or they can use that capital in any other way they see fit. Get out of the apartment, sell the first home, and live van life. Buy a Sprinter van and live your best van life. So all that is to say that there's options, but first-time buyers who don't have that equity capital from the first home, that's a struggle. That's where the real struggle is. So some have asked the question: are millennials sort of hoping for a market crash? Unfortunately, I can sort of understand why they are. I do not wish for that. I think most people do not wish for that, but I can understand why they think that's kind of the only way they might be able to get a home. What percent of buyers are younger millennials? 18%. But that group is only 6% of sellers. Interesting. As soon as you get into Gen Xers, now you're starting to see more sellers than buyers. And as you get into boomers, of course, more are going to be sellers than buyers. Still some buyers for some downsizers. These guys are selling the single family and getting into the townhome. What's also happening is these guys are selling the single family and they're going into institutional care, memory care, some sort of senior living arrangements. And then those silent folks, sort of an interesting generational thing. All right, here we go. This pretty much sums it up. Millennials, boomers, right back. Gen Z just kind of crying in the corner, and Gen X is just saying, cheers as they watch the world burn. Anyway, thought that was a little bit entertaining. Age of home buyers, who's right in the middle, 36ers. Those are your older Ys, your older Y and your millennials. 36, that's 25% of buyers. You guys can kind of see how the breakdown looks from there. Okay, we're at 57. Let's see. I can't believe I'm even going to get to it. Let's do a couple economy slides very briefly. I'd tell an economics joke, but I think there's not enough demand for it. I know this is several months old. I did look at, was it Jan or Feb? And I think we're a little bit lower, but some of that is seasonal, guys, seasonality. This is not seasonally adjusted. Well, what do we know? As we get into the growing season, seasonal labor is more of a thing in the South or in say California, where in some regions where it's much more, what's the word, agro-productive, maybe more agricultural, and I know we're in the heartland with corn and wheat and soy and all that good stuff, but I think it is partly the fact that this is not seasonally adjusted. And so sometimes in the winter months we'll look stronger, but then in summer months maybe a little bit less so. All that is to say, we're a really competitive labor market. We have the second, as of several months ago, we had the second lowest unemployment rate out of any major metro area. Yeah, maybe this isn't the best one to do. Guys, don't even look at the trend lines up top. Only look at the green boxes at the bottom. As we started to see, 2 out of 4, we never really saw 3 out of 4. But as we started to see a good number of these boxes turn red, and for a few months, people started to raise the flag. Could we be knocking on the door of a recession? And then we're seeing more green. Let's see what the rest of March looks like when these data come in. Uh, you know, I don't see, a recession imminent next month, although many are saying, later this year, long story, longer, let's see what happens. Inflation still sticky above the Fed's 2% target. So this is kind of what's causing some of the tumult, or the turmoil, if you will, in markets, capital markets, bond markets, MBS markets, you name it. And so you guys can kind of see inflation, the Fed is looking for 2%. They've been a little below, a little above, a little below, a little above, way above, but we still haven't gotten back to that 2%. We're kind of sticky at right around 3%. Let's kind of see what happens. One interesting way to think about this is, well, let's look at shelter. So here's CPI in red. Here's where we're kind of sticky. We're stuck around 3%. But look at shelter prices starting to come down. This has a lot to do with rents. We've been building a lot of new rental units. That has meant vacancy rates have come up, which means less price pressure. That means rents are leveling off or falling a little bit. And hopefully that'll start to bring this down as we move forward. I know we're just about at time, guys. Job growth is strong, sort of shockingly strong, if you will. Quick rate forecast. This was before we saw the CPI data. Dr. Lisa is thinking we could be 6.25 by the end of this year. Let's see what happens. As we say, is this Fannie Mae? Fannie Mae was also saying, well, as of December of last year, they were thinking 6.5% by the end of this year. As of January of this year, now they were thinking 5.8, but they were factoring a lot of Fed rate cuts in, and I'm afraid we're not going to see as many. I've even heard a couple people say we may not see any. I guess I'm in the camp that we see 1 or 2. I don't know if that'll be July or later. All that remains to be seen. All right, here we are. Thank God we're wrapping up. Let's do this one. This is a really important one. Just let me go just 2 minutes over, guys. Recession does not mean housing crisis. 4 of the last 6 recessions, home prices rose. If you have clients who are, concerned and talking about, I'm going to wait for a recession to be over because I know home prices always fall during a recession. I want you to take this slide, look them right in the eye and say, with all due respect, you're a great person. I love working with you, but you're dead wrong, right? You are dead wrong. All right, last one, home price forecast. So thinking about 2.1, mortgage folks thinking more like 4, realtor.com surprisingly thinking more like minus 1.7. And then I'll leave you guys with these two. So ever since I went to the vet, everything has been loud as heck. He's got the funnel because he got the stitches and he doesn't want to scratch, or he got something taken out and don't want to lick. So guys, we've all got the noise amplified. It seems like there's more noise nowadays. I hope some of this and some of these tools can help you cut through the noise. A lot of noise. So I hope this can help you cut through the noise and kind of get at the truth a little bit more. We always like to say most agents can kind of know what's happening. Good agents understand what's happening, but the great agents can really explain and convey what's happening and talk to their clients about why it's important and why it matters. And then lastly, while we cannot control the winds, we can adjust our sails. and the best agents can be successful in up, down, and sideways markets. And with that, I will say thank you. Thank you. Really honored that you guys joined us. Thanks for sticking around. And guys, I'll just say, get on a committee, apply for something, get on the board, use the data, just get engaged. We're really trying to kind of up engagement and really up professionalism. So don't overlook some of this stuff, you guys. And with that, I'll pass it back to the one and only Jackson.
Thanks, David. Really appreciate your insights on all of that. Do we have any questions for David before we end the webinar? And while we're waiting for any potential questions to come in, feel free to either use the chat or the Q&A. I am going to put a link to our next webinar, May 16th, 2 p.m. to 3 p.m., same time as always. Please click on that link right now if you can and register right away so that way you don't forget. And I don't see any questions, David, so I'm going to leave it at that. Let's close up shop here for today, and we will see you all next time on our monthly housing market webinar in May.
Thanks, everybody.
Take care.